this video, we're going to explore whether investing in stocks is a good idea for beginners or not. Investing can be a fantastic way to grow your wealth over time, but it's essential to understand the basics and assess if it's right for you. Let's dive in. Step 1. Understand the stock market basics first. Understanding the basics of the stock market is crucial for beginners. When you invest in stocks, you're essentially buying ownership or shares in a company. This means you become a shareholder and have a stake in the company's success. The value of your shares can go up or down depending on various factors, including market demand and how well the company performs. For example, if you invest $1,000 in a tech company and its stock price increases, the value of your investment also goes up. Conversely, if the company faces challenges or poor performance, your investment's value may decline. It's essential to remember that stock market investments come with risks, and thorough research is vital to make informed decisions. Step 2. Assess your risk tolerance. Assessing risk tolerance is a critical aspect of entering the world of stock market investments, especially for beginners. It involves taking a close look at your personal comfort level when it comes to the possibility of financial losses. This introspective assessment is fundamental because everyone's financial situation and risk tolerance can vary significantly. For newcomers to the investment scene, it's often advisable to lean towards low-risk options such as index funds or exchange-traded funds. These investment vehicles allow you to diversify your holdings across a broad spectrum of stocks or bonds, spreading risk and potentially minimizing the chance of significant losses. Step 3. Set your clear investment goals. Setting clear investment goals is a crucial step for beginners in the world of stock market investing. To begin, it's essential to define your financial objectives, which could range from saving for retirement, purchasing a new home, or funding education expenses. Next, you'll want to determine your investment horizon, whether it's short-term or long-term. For instance, if your goal is to save for retirement over the next 30 years, you'll likely want to consider long-term investment options like individual stocks. These stocks have the potential for significant growth over an extended period, aligning well with long-term financial objectives. Step 4. Build a diverse portfolio. Diversification is a key strategy to reduce risk when investing in stocks, especially for beginners. It involves spreading your investments across different asset classes such as stocks, bonds, and cash equivalents. Instead of putting all your money into a single company, consider a well-balanced mix. For instance, rather than investing solely in tech companies, diversify your portfolio by including stocks from various industries like healthcare, finance, and energy. By doing so, you can mitigate the impact of poor performance in one sector, as gains in other areas can offset potential losses. This balanced approach can help safeguard your investments against market volatility and increase the likelihood of long-term success while minimizing risks associated with a single investment. Step 5. Research and analysis. Research and analysis is a crucial component of successful stock investing for beginners. It involves taking the time to thoroughly examine companies before making any investment decisions. This process includes delving into a company's financial statements to gauge its fiscal health, studying earnings reports to understand its past performance and future potential, and keeping a close eye on industry trends to see how external factors might impact the company's prospects. Examining growth prospects, such as new product launches or expansion plans, can provide insights into the company's future potential. This diligent research and analysis process empowers beginners to make informed investment choices, reducing the likelihood of unforeseen setbacks and enhancing their chances of achieving their financial goals. Step 6. Start with a brokerage account. To kickstart your investment journey, the pivotal step is selecting a trustworthy online brokerage platform. The process involves choosing a platform that aligns with your specific needs and preferences, considering factors like fees, available investment options, user-friendliness, and customer support. Once you've made your choice, the next step is straightforward. Open an account with the selected brokerage, which typically involves providing personal information, verifying your identity, and agreeing to their terms and conditions. After your account is set up, you'll need to deposit funds into it, which can be done through various methods such as bank transfers or electronic payments. Once your funds are in place, you can start trading. These online platforms offer user-friendly interfaces, educational resources, and trading tools designed to assist beginners in navigating the stock market with ease, making it accessible for even the most novice investors to get started on their investment journey. Step 7. Dollar cost averaging. It is a smart strategy for beginners. It involves investing a consistent sum of money at regular intervals, such as monthly or quarterly, regardless of market conditions. This approach helps reduce the impact of market volatility on your investments. Here's how it works. When prices are high, your fixed investment amount buys fewer shares, and when prices drop, you purchase more shares for the same amount. Over time, this can result in a lower average cost per share, potentially increasing your overall returns. For example, if you invest $100 every month during market lows, you'll be able to purchase more shares, capitalizing on the opportunity. Conversely, during market highs, your fixed investment will buy fewer shares, preventing you from overcommitting when prices are at their peak. This consistent, disciplined approach minimizes the emotional response to market fluctuations and can lead to more stable, long-term growth in your portfolio. Step 8. Monitor and adjust. Regularly monitoring your investments is a crucial aspect of successful stock market participation, especially for beginners. It entails keeping a close watch on how your investments are performing and making adjustments as needed to align with your financial goals. Monitoring involves staying informed about market conditions, tracking the progress of the companies you've invested in, and assessing whether they continue to meet your expectations. For instance, if a company's performance takes a downturn, such as declining revenue or profitability, it might be a signal to reconsider your investment in that stock. In such instances, a wise strategy can entail selling the underperforming stock and reallocating your resources elsewhere, possibly in a more promising investment opportunity. This responsive approach to investment management guarantees that your portfolio stays on track with your goals and adapts properly to market fluctuations, eventually contributing to your financial success. Step 9. Seek professional advice. When it comes to investing, seeking professional advice is a crucial step, especially if you find yourself uncertain or inexperienced. Consider consulting with a financial advisor who can offer personalized guidance tailored to your unique financial situation. By collaborating with a financial advisor, you gain access to invaluable insights that can optimize your investment strategy and increase your chances of achieving long-term financial success. Remember, it's a smart move to tap into their expertise and experience to ensure your investments are in line with your financial objectives. Overall, investing in stocks can be a good idea for beginners if approached wisely. It's essential to educate yourself, assess your risk tolerance, set clear goals, and build a diversified portfolio. By following these steps, you can embark on your investment journey with confidence and potentially reap the benefits of long-term wealth accumulation. That's all in this session. See you in the next video. Happy investing!